Most people hear the phrase distressed mall acquisition and immediately think buy a dying mall cheap, fix it up, make a profit. That's the headline version. But the real process is much more complicated and much more interesting. Distressed and closed malls don't usually trade like normal commercial real estate assets. They often move through default, special servicing, then receivership, then foreclosure, messy title issues, tenant uncertainty, environmental diligence, and months, sometimes years of negotiation before a new owner ever takes control. And that's exactly why opportunities exist. In this video, we're going to walk through how distressed and closed mall acquisitions actually work from the inside, how these properties become distressed, how we identify them, what happens behind the scenes with the lenders, with the special servicers, how the acquisition timeline unfolds, where value is really created, and what risk investors need to understand before assuming a steep discount that automatically equals a good deal. Because in this business, the discount gets your attention. Execution is what creates the return. Distress usually doesn't happen because of one single problem. It tends to be the result of three forces coming together. The first, over-leveraged capital structures. During the 2005 to 2015 cycle, many enclosed malls were financed with CMBS loans at 70 to 80% loan-to-value ratios. These loans were based on peak valuations. But as retail trends shifted, department stores closed, e-commerce grew, weaker malls lost traffic, values, they started to fall. When that happens, the borrower can get trapped. They may owe more than the property's worth. They may not be able to refinance. They may not be able to sell for enough to pay off the loan, and they may not be willing or able to inject more equity, more capital into an asset that's already declining. A good example is White Marsh Mall in Baltimore. Its appraised value reportedly fell from around $300 million at CMBS origination in 2013 to about $80 million by mid-2024. That's a roughly 73% drop in value. The second force is deferred maintenance. When an owner knows they're losing money on a property, they often stop reinvesting. The roof sections get patched but not replaced. HVAC systems are pushed well beyond their useful life. Parking lots crack, lighting gets worse, common areas feel dated. That physical decline affects tenant confidence. Tenants leave, income drops, and then there's even less money available for repairs. It becomes this downward spiral. A third force is anchor departures. When an anchor like Sears, Penny's, Macy's, when they close, the mall doesn't just lose rent from that one box, it loses traffic. And in many cases, inline tenants have co-tenancy clauses in their leases. Those clauses may allow them to reduce rent or even terminate early if anchor tenants go dark. So one major closure can trigger a chain reaction. What happens? Traffic drops. Tenant sales decline. Rent concessions increase. More tenants leave. Net operating income falls, and before long, the mall can no longer support its debt. That's usually when the loan gets transferred to special servicing. This is where distressed mall acquisitions really begin, when a CMBS loan stops performing normally. It can be transferred from the master servicer to a special servicer. A master servicer handles normal loan administration, but a special servicer handles problem loans. And that distinction really matters. The special servicer is not a mall operator. They're not trying to reinvent the food court or re-tenant the former department store or design a mixed-use redevelopment plan. Their job is to maximize recovery for CMBS bondholders. That usually means evaluating one of three paths. They can modify the loan and try to return it to performing status. They can foreclose, take control of the property, and eventually sell it as REO, real estate owned. Or third, they can facilitate a discounted payoff, where the borrower or third party buys the note at a discount. This is the supply pipeline for distressed acquisitions, and that pipeline has been significant. According to the source material, the overall CMBS special servicing rate reached 10.84% in October of 2025, a 12-year high, with retail remaining a major contributor. In practical terms, this means tens of billions of dollars in loans are being actively managed as troubled assets rather than normal performing loans. For experienced operators, that creates opportunity, not because every distressed mall is a good deal. Most are not. But because special servicers typically want resolution. They're not long-term holders. They're not repositioning specialists. They want to clear the loan from their book in a way that satisfies their fiduciary obligations. That urgency is where an operator can step in. Now, let's talk about the actual acquisition process. A distressed mall deal usually does not happen in 30 or 60 days. A realistic timeline from identification to closing is often 9 to 18 months, and sometimes longer if there's litigation or bankruptcy or title issues. The process generally unfolds in 4 stages. Stage 1, the identification and initial diligence. This is typically the first 1 to 3 months. We monitor CMBS surveillance reports, TREP data, special servicing transfers, court filings, local market news, and properties showing signs of financial deterioration. The first signal might be a loan transferring to special servicing, but that alone doesn't make it attractive. We immediately look at the fundamentals. What are they? What's the trade area? What are the demographics? Is population stable, growing, shrinking? Who are the competitors? What anchors are still operating? What anchors have gone dark? Most deals get screened out early. In this business, you may look at 50 distressed situations to pursue 5 seriously. Stage 2, that's receivership or REO. If the borrower cannot cure the default, the lender may petition the court for a receiver. The receiver is usually a third-party property management firm appointed to operate the mall, to collect the rent, to pay essential expenses, and to preserve the asset while the legal process plays out. During this period, the property often is just in limbo. Tenants are uncertain. Vendors, they could be cautious. Deferred maintenance continues to build. This phase can last months. In a complicated situation, it can last years. Stage 3, that's negotiation with the special servicer. This is where the real work begins. We may submit an indication of interest, get access to the data room, review the rent rolls, the leases, loan documents, service contracts, prior appraisals, environmental reports, and property condition assessments. Then we start underwriting. But underwriting a distressed mall is not like underwriting a stabilized grocery-anchored center. You cannot simply take last year's NOI, apply a market cap rate, and call it done. You have to ask, what income is actually durable? What's stable? Which tenants are likely to stay? Which tenants are paying below market? Which tenants are overpaying and likely to renegotiate their rents down? What capital improvements are absolutely required? What's the true cost of stabilizing the property? And at the same time, the special servicer has its own process. They may need updated appraisals. They may be bound by a pooling and servicing agreement. Offers below appraised value could often require additional approvals or even bondholder consent. That means even when both sides want a deal, the transaction can move really slowly. Stage 4, it's title clearing and closing. Distressed assets often come with messy title. There may be like unpaid contractors or mechanics liens or delinquent property taxes, tenant claims, judgments, unresolved easements, old agreements tied to anchors, old agreements tied to out parcels. This stage can feel less like a normal real estate closing and more like untangling a legal knot. Sometimes the seller or special servicer resolves certain issues before closing. Other times, the buyer prices that risk into the deal and handles it post-closing. Either way, This is one reason distressed deals reward patience and experience. The common assumption is that value is created simply by buying at a discount. And yes, the discount does matter. Distressed malls may trade at 50 to 80% below prior valuations. That lower basis can provide a real margin of safety, but the discount's only the starting point. The real value creation comes from three things. First, resetting the capital structure. The prior owner may have been crushed by debt based on an old valuation. When we buy the asset out of distress, that old capital structure, it goes away. We're starting with a new basis, a new financing plan, and ideally a more conservative leverage profile. That changes everything. Debt service becomes more manageable. The property does not need to perform like a $300 million asset if we bought it at a fraction of that value. This gives us room, a cushion to invest, room to make mistakes, room to reposition the property over time. Second, addressing deferred maintenance. This part is not glamorous, but it's critical. A new roof section, better lighting, repaved parking lots, updated HVAC, clean bathrooms, improved signage, refreshed common areas. These are not the things that make headlines, but tenants notice them immediately. When tenants have been watching a property decline for years, visible reinvestment changes the conversation. Suddenly the owner is engaged. The property has a plan. Brokers return calls. Prospective tenants, they're more willing to tour. Existing tenants who are thinking about leaving may reconsider. Third, resetting tenant relationships and economics. Distressed malls often have leases that were negotiated from a position of weakness. Tenants may have received rent concessions or temporary deals or below market terms because the prior owner needed occupancy at almost any cost. As leases roll, a new owner can renegotiate from a stronger position, but only if the property is improving. This is where operations matter. You cannot just raise rents because you bought the mall. You have to earn that right. You have to earn that rent growth by stabilizing the property, investing in the asset, improving the traffic drivers, giving tenants a reason to believe in the location. Over years 2 through 5, that combination, lower basis, capital improvements, better tenant economics, is what can drive NOI growth. Now, we need to be very clear. Distressed mall acquisitions, they're not easy money. The risks are real. One major risk is environmental liability. Older enclosed malls may have asbestos in floor tiles, pipe insulation, or ceiling materials. Former automotive tenants may have underground storage tanks. Stormwater systems may have contamination issues. Environmental remediation can cost hundreds of thousands of dollars, and in serious cases, several million. Another risk is lease complexity. During receivership, foreclosure, or ownership transition, tenant rights can become complicated. Some tenants may have termination rights. Others may use that transition to renegotiate. Some leases may have co-tenancy clauses or exclusive use provisions or ambiguous assignment language. Untangling the lease structure can be one of the most time-consuming parts of the first year. A third risk is underestimated capital needs. Property condition reports are useful, but distressed assets almost always have hidden issues. Fire alarm panels may be obsolete. Roof repairs may become roof replacements. A renovation permit may trigger code upgrades. Underground utilities may be in worse shape than expected. As a rule of thumb, if the building condition assessment says one number, we assume the actual number may be 20 to 30% higher. And then there's timeline risk. A deal that looks close can get delayed by borrower litigation, bondholder disputes, title problems, bankruptcy filings, or court approvals. Meanwhile, the asset keeps deteriorating. The mall you underwrite in month 3 may not be the same mall you acquire in month 18. That's why disciplined underwriting is essential. For investors, the key question is not simply, Can this mall be bought at a discount? The better question is, does the operator have the team, the capital, the relationships, and the experience to convert that discount into durable value? Because distressed mall acquisitions are not quick flips. They're operational turnarounds. The acquisition creates the opportunity. The execution determines the outcome. That's how distressed and closed mall acquisitions actually work. From the first signs of distress to special servicing, to receivership, to closing, and ultimately to repositioning. And for the right operator, with the right asset in the right market, that complexity is not a problem. That complexity is the opportunity.